We're looking here at Chapter 17 related questions, and we're going to start off by talking about some examples where things are and are not included in your income. So number one says Polly received the following items this year. Interest on New York City school bonds, $1,600. Gift from grandparents, $5,000. Jackpot from state lottery, $42,500. And gambling winnings of $3,000. And it wants us to compute Polly's gross income. Right, so in other words, which things are included in gross income and which things are not included in gross income. So first one here we have the interest on New York City school bonds. Right, so one thing we want to make sure we're talking about at the federal level because there's sometimes at the state level this does not hold true. Right, but if you're talking about local and municipal bonds, these are non-tax at the federal level. So even if you had something in a state. So at the federal level, they're not taxed. And why did I make sure to say federal? Because what you'll see here is your states work different on that. So if I'm in North Carolina and I have a municipal bond and that municipality is located within North Carolina, then they're going to go along with that being tax-free. But if I have a municipal bond or in Virginia or another state, most of the time your states are not going to have it be tax-free if you have it within another state. Right, but it is at the federal state, it depends. The gift from the grandparents, right? That's going to be, and again, we're talking about the federal level. At the current time, North Carolina does not have a gift tax. We used to, if you look back, and it wasn't one of the more friendly gift tax guidelines. But there may be a handful of states that still have it, where not only do you need to look at your gift limitations on the federal side, but the state. So if you are working with somebody in a different state, just keep check with that. But again, we're talking about the federal level. But so gifts from the grandparents at the federal level, that's non-taxable. Right. So again, we're talking, and the amount there makes a difference. So we're talking about $5,000, and that's going to mean that it's below the amount. So when you go into gift tax, that's definitely a specialty area. But just in general, you'd be looking at a yearly amount you could exclude. So you could give each person this yearly amount and not have to file anything. And then what you would do is after you went over that amount, you could still give it to the individuals and file a return. So you'd file a return, and then you'd use another what they call lifetime exclusion limit. So after you give up what you could give in each year to a person, and you've gone over that, then you're really just going to do a paper return and say, okay, we know we've gone over the yearly amount. Now I need to file, but I'm going to take it out of the lifetime limit I could give them. Right, so if you work with a super high income individuals, you may run into that, but the exclusion amount for lifetime is millions and millions currently. So it still pretty much just turns into a paper return. But now at that point you do want to find out information about who you've given it to. Make sure that you can get their social security number and information like that. So that is the gift from the grandparents. The other two items, though, these are going to be taxable and included in gross income, too. So you notice those other things were not included in gross income, but the jackpot from the state lottery, that's going to be included, and the gambling winnings of $3,000. So those two added together is what? C, $45,500. Number two says James Dean received the following this year: had scholarship for college tuition and fees of $20,000, had scholarship for college room and board of $13,100, had a Chamber of Commerce citizenship award of $1,500, and had an inheritance for the great uncle of $38,000. Okay, so on these, notice and you can probably already guess, there's going to be a difference in how the tuition and fees scholarship is treated from the room and board. Right, so the tuition and fees not included. However, the Room and board is included. The only thing you can exclude is tuition and fees. So that's why you need to make sure where the scholarship money is going to. Then you have the Chamber of Commerce Citizenship Award. Right, that is included. However, the inheritance, that is not going to be included. If there is anything to be paid related to the estate, that would be an estate tax return, not on the individual of the person who is inheriting it. Right, so we have two things here, right? The scholarship for the room and board of $13,100 and the Chamber of Commerce Citizenship Award of $1,500. So those come up to B, which is $14,600. 3 says, Mr. and Mrs. Trent divorced last year. Pursuant to the divorce, Mr. Trent transferred marketable securities to his Mrs. Trent. This year, Mrs. Trent sold the securities for $112,000. Which of the following statements is true? Right, so the thing is with divorce, it's carryover basis. Right, the only time you would get step up in basis would be if you had the inheritance, if you inherited it through an inheritance. And I can't help but chuckle, but I have worked with a couple of people who swore the divorce was just like a death to them. But I said, well, we still can't use that as as a basis to get step up. So divorce, you get carryover basis. Why is that important? Right. So when it went to Mrs., it stayed at $67,000 as her basis. She didn't get to go up. Right. She didn't get to go up to 100,000. So that means when she sells it here, she has $112,000. That's the amount realized. The basis was $67,000. Right, so if we do the difference, that's going to be the amount of gain that she recognizes. So let's see here. 112 minus the 67,000. That means there's going to be a gain here of $45,000. Right, so let's see which one of these it is. A. A says Mrs. Trent recognized a $45,000 gain on the sale this year. Okay, number 4 says Mr. and Mrs. Scholler received $25,200 of Social Security benefits this year. Their only other source of income was Mrs. Scholler's $10,479 taxable pension from her former employer. How much of their Social Security is included in gross income? So let's go over here just a minute and let's look at some, because we're going to need these guidelines or these numbers for the next couple of questions, but it's been a little while since we talked about Social Security. So with Social Security, the key is with income, if you're under a certain limit, you don't have anything taxed as far as your Social Security. And when I say under a limit, I mean what they consider your other income. Then when that other income goes over a certain limit, some of it starts being taxed. And then after you reach a certain limit, all up to, well, I guess even more of it starts to become taxed. So up to 85% can be taxed, but if you're in a low enough income bracket other than your Social Security, none of it may be taxed. And I was trying to look for, here's the ranges. So we'll just skip to that. So you notice it says married couples with less than $32,000 and single individuals with less than $25,000 of modified AGI don't pay tax on their benefits. And what does modified AGI means? It basically means your AGI before any of this Social Security would have been added to it. Then you notice if you are between $32,000 and $44,000 and married, or single and between $25,000 and $34,000, right? That's not a big gap. 12,000, and then that's what, 9,000. You pay 50% of your Social Security income is going to be included in taxable income. So that's not a big range for that middle part. And then it says couples with more than $44,000 and single individuals with more than $34,000 of modified AGI pay tax on 85% of their benefits. Right, so there's not going to be a time when all of the Social Security is included in taxable income, but you could have a time, and often do, where 85% is included. So let's go back over here and look at this question again. So notice this is a Mr. and Mrs. received $25,200 Social Security benefits. Their only other source of income was Mrs. Schwoller's $10,479 taxable pension. Right, so that's the number they're going to be looking for, is the other, and we see that that's safely below this 32,000 for married couples. Right, even though it only came from one person, they're filing as a married couple. Right, so how much of it is going to be included? Right, none of it is. So then we're going to move up a little bit, as you can probably imagine. It says Mr. and Mrs. McGraw received $50,160 of Social Security benefits this year. They also received $108,000 taxable pension payments and earned $47,300 interest and dividends from their investment portfolio. How much of the McGraw's Social Security is included in gross income? Right, so what would be included, modified AGI would be the other things that would be included other than Social Security. So 108,000 and 47,300. Right, so you can see we're going to be safely above the other side of it, right? It's going to be easily above $44,000 for the married couple. So that means this 50,160, 85% of it's going to be taxable and included in gross income. Right, so if you take 50,160, hopefully I updated my numbers, 42,636, or C, that's going to be the taxable portion, or the part that's included in gross income.